In this video, I'm going to show you how to improve your success rate with technical analysis. To start off, let's see the Sensex chart of 2008 when the market tanked all the way from 21,000 to almost 8,000 in a span of 10 months. Let's see what the so-called experts were saying during this time. At the beginning of the year, Citigroup came in and predicted that Sensex could end the year at 25,000. A little into end of January, an Economic Times roundtable headed by Ramesh Damani predicted that the Sensex could hit 29,000 target by December 2008. CEO of Reliance Money said that there would be a lot of upside in the market after correction. The market was still sliding. Deutsche Bank came in and set the target of March 2009 to 18,000 and the market had already slid to 17,000. Again, Citigroup came and said the same thing, that they were lowering the target to 18,500 by March 2009. And what did the market do? It ended all the way down, almost half, to 9,000 by March 2009. So how do you make sense of this market? Do you follow CNBC and the technical analysts who come there? Or do you follow broker advice? Most broker advice is propagated by the head offices and oftentimes is after the fact. Or do you follow stock tips? Well, we get a lot of customers who want to use our software who have got frustrated by following stock tips which don't work. Or follow an astrologer and just follow the stars. Well, we feel that you should be making your own decisions. So what are the pitfalls of following others? First, you have to make sure that the advisor is good. Second, advice given on CNBC or that provided by brokers is after the fact. And even if you got the advisor right, what if the advice does not reach you in a timely manner? When the market tanks, you want to know that you have to sell the stock right then. Any delay is going to be very harmful to your portfolio. Okay, but can I beat the so-called experts? Well, the simple answer is yes. And if college dropouts can learn and apply technical analysis, and which is a fact, so can you. You don't need to be a mathematical genius or you don't need a PhD degree to be able to apply technical analysis. All you have to do is learn the basics of technical analysis and practice them effectively to improve your success rate. So let's look at the Sensex chart again and see what a simple technical analysis technique called support resistance analysis would have helped us get out of the market early. In technical analysis, you can draw certain support and resistance levels as is indicated by the three red lines shown here. These are all support and resistance levels. Now this particular level is called a support because when the price bounces off that particular level, it is called a support. Right here, when the Sensex broke the support, it was a very negative sign and a sign to exit the market. So this was the first sign for you to get out of the market completely. If you did not end up getting out of the market completely, or say you sold partially, the second chance came when the market actually tried to recover back to this level again. In technical analysis, when a support is broken, it becomes resistance. The resistance is a level where the prices are not able to penetrate or go above the level. So when the prices were recovering, they could not have penetrated the resistance, and hence this was your second chance to get out. So you can see that just by knowing these levels, and this would hardly take a minute to analyze on a Sensex or any particular stock chart, would have gotten you out of the market at the right time. We're going to talk a little more about these concepts a little later, but first let's look at what are the factors that affect stock prices. A lot of factors like world economy, oil prices, natural calamities like the Japanese earthquake, politics, change of government to a stable government, and the changing of company management which causes fluctuation in the stock prices. All these factors affect the stock prices, and when you're studying the historical stock prices, to predict the future stock prices, it is called technical analysis. As simple as that. How accurate is technical analysis? Well, just as weather forecasting can never be 100% accurate, the technical analysis also can never be 100% accurate. You must have seen weather forecasters. A lot of times they predict a sunny day and then it turns out to become a rainy day. Just like that, in technical analysis also, you can get wrong sometimes, but our goal is to learn and apply the concepts so that our success rate is as high as 85%. Now, what do I mean by that? A 80% success rate means that 8 out of 10 trades are successful. Now, anything more than 50% is good, but when you are at 80%, you are going to be darn good in the market. So, will technical analysis help me if I am a long-term trader, a short-term swing trader, or an intraday trader? And the good news is that technical analysis is useful for all kinds of traders. Once you learn the basics of technical analysis, the concepts are applicable to all. So what are the reasons that people give for not using technical analysis? First, it doesn't work. Well, the people in this camp do not understand that it is not a 100% guaranteed technique, and nothing in this world is going to give you a 100% success rate. Those people who get one failed trade conclude that it doesn't work, which is not really true. Even if you have a success rate of 80%, you're going to trade profitably in the market, and that is all that matters. It's too complicated for me. The people in this camp are going by the terms technical analysis and get intimidated by it because of its mathematical formulae. But the good news is that you don't really need to understand the mathematical formulae in order to apply it practically. And finally, a lot of people say, I do not have the time. And people who say this are not using technical analysis software correctly or the right technical analysis software, because if you have the right technical analysis software, the time taken to use it is hardly some 15-20 minutes daily, or if you're a long-term positional trader, hardly some 15-20 minutes every week. So what is a trend? A trend in the market is the direction of the market. Market is either going upwards and it's said to be in an uptrend, or it is going downwards, in which case it is said to be in a downtrend. And if it is neither going up nor going down, then it is said to be in a sideways trend or non-trending market. So what is an uptrend? In the stock market, the prices never move in a straight line. It's impossible. They're always going up, down, up, down, up, down, up. But if you can generally say that the market is going in an upward direction by drawing a line like this, which is also called a trend line, then it is called an uptrend. Similarly, in a downtrend, the market is going down, up, down, up, down, up, down. But generally speaking, if it is going down, then it is called a downtrend. And if you find that the market is going up and down and oscillating between two levels, then it is called a sideways trend. So these are the three different types of trends, directions of the market that generally someone can analyze. And analyzing these three trends, understanding these three trends and what the current trend of the market is very important to technical analysis and is called trend analysis. Why is understanding the trend important? The reason is because 75% of the stocks follow the market trend. And if you trade in the direction of the trend, it maximizes your chance of success. So for example, when the market was tanking all the way from 21,000 to 8,000, if you were actually long on the market, bullish on the market, you were on the wrong side of the market and you would be losing money. Knowing the trend also helps you use other indicator and candlestick patterns correctly and eliminate false signals. Some analysts like to say that trend is your friend. Let's talk about the next topic, which is support and resistance. Now in the market, the prices, when they are moving up and down, there is a level at which the prices bounce off and bounce off again. And this level at which prices bounce off is often called support, because it's very similar to when you drop a ball on the ground and the ball bounces off the ground acts as a support. Just like that, when the prices actually are going up and hitting a ceiling, that level where they hit a ceiling and come back down again is called a resistance. So this is the basic concept of support and resistance. And support is usually a line that is drawn through the bottoms in the chart, while resistance is a line that is drawn through peaks in the chart. Analyzing support and resistance is very important, as we saw in the Sensex chart before. It helped us correctly get out of the market early. And in the Sensex chart we also saw that the support and resistance roles are interchangeable. A support, when broken, becomes resistance and vice versa. You have to draw different support and resistance levels in the chart and know the strength of different levels. Now, although this is a very short video, we conduct a basics of technical analysis training, which is almost 3.5 hours, in which we go into in-depth support and resistance and tell you with an example of a Sensex chart how to analyze the support and resistance levels and use them to predict future prices. So giving you a practical example of a Sensex historical chart. And we also give you what are the factors that determine the strength of different levels, because if you know that, then you know what importance you need to give to the stronger support and resistance levels. If we were to summarize the technical analysis techniques, they fall into various categories. First is the support, resistance and trend analysis, which I talked about. Second is technical indicators, which we'll talk about shortly. Third is Japanese candlesticks, and fourth is classical patterns. We're not going to cover the last two techniques. So let's talk about technical indicators now. Now technical indicators are what probably make the topic of technical analysis look complex. They're basically based on mathematical formula derived from mostly the price and volume. And the examples of technical indicators are moving averages like EMA and SMA, and other simple basic indicators like RSI, MACD, stochastics, ADX, etc. Let's look at the simple moving average. Simple moving average is basically moving average of the closing prices. It is basically taking the average of the last few days worth of closing prices. And how many days do you consider in that? The number of days indicated by the parameter of the simple moving average. So in this case, if you look at SMA 5 for example, it is basically the moving average of the last 5 days closing prices. Now one of the technique that is used to generate the buy and sell signals in technical analysis involves two moving averages of different parameters crossing each other. Let's see an example. So for example, when the 5-day SMA, which is a smaller parameter SMA, crosses above the bigger parameter 20-day SMA, it is considered to be a buy signal. And when the 5-day SMA crosses below the 20-day SMA, it is considered to be a sell signal. If we see this on a chart, it looks like this. This is a chart of Voltamp Transformers Limited, and it is a candlestick chart where the red line is basically the SMA 5 and the blue line is basically the SMA 20. When the red line crosses the blue line over here, it is a buy signal, and when the red line crosses below the blue line, it is a sell signal, as indicated in my previous slide. So this is how a buy and sell signal is generated in technical analysis. A simple example of using a technical indicator. If you bought using the buy and sell signal just mentioned, you would have doubled the money in less than 3 months. However, you will notice that there are quite a few crossovers over here, and these actually are not real signals, because if you were to follow them, you would actually end up losing money. Hence, they're called false signals. One of the concepts that you have to learn is how to detect these false signals. And the reason why we call these false signals, for example, is because SMA is actually an indicator which works well in an uptrend and downtrend. It doesn't work well in a sideways market as is indicated over here. That is the reason why these are all false signals, and knowing the trend analysis correctly, knowing the trend correctly, you can actually detect it and avoid acting on these signals and get your success rate up to a much higher percentage. So here's a summary of what I told. You need to understand the current trend. Understanding and analyzing the trend, as we showed earlier, is done using trend analysis and drawing trend lines. Then you need to avoid the buy and sell signals if the indicator does not work well in that trend. For example, avoid moving average crossovers in a sideways trend. So if I were to summarize the entire topic of technical indicators, it is basically you need to understand how to use the most important technical indicators, learn how to avoid false signals, and always use more than one indicator to make your buy-sell decision. So this is the second important point. Never use only one indicator. You need to use more than one indicator or technique to make your buy and sell decision. So what are the ingredients required to getting the success rate to 80%? First, learn the importance of different techniques, support and resistance, technical indicators, Japanese candlesticks, and classical patterns, which is a little more advanced technique. In the Basics of Technical Analysis course, we talk about support and resistance extensively, and the basic technical indicators and Japanese candlesticks. Always use more than one technique to generate buy and sell signals. And you also learn to detect and avoid false signals. So what are the main things, if we were to draw in a graphical way, to get the success rate to 80+%? First, you need to do your trend analysis, know the current trend. Then you need to do your support and resistance analysis, know the different support and resistance levels. And finally, know the basic technical indicators and understand when each of them gives a buy and sell signal. Combine all these three things and you can get your success rate to 80% plus. So this is what we actually emphasize in our Basics of Technical Analysis training, which is a 3.5 hours of practical training. 1.5 hours is spent on support and resistance analysis and trend analysis. The next 1.5 hours is spent on the basic technical indicators and Japanese candlesticks, understanding when buy and sell signals are generated in each of these indicators. And then finally, combining different techniques to come up with a buy and sell decision. And towards the end of the session, we analyze one particular stock completely, showing you when you could have bought that stock and when you should have sold that stock, so that you can apply the analysis technique to any stock of your choosing and come up with your own buying and selling decision. Our goal in this practical training is to enable you to come up with your own buying and selling decision. So what do we not teach in this training? We don't cover any mathematical formula and we don't cover any theory. This we believe you can easily find out in books and Google. The value that we add is that teaching you practical technical analysis concepts, how to avoid the false buy and sell signals, which is the trickiest part of technical analysis, and how to improve your success rate to 80+%. And the most important thing is you learn to make buy and sell decisions to trade profitably in the stock market. Here are the different topics that are covered. First, we talk about what is technical analysis, different types of charts like line chart, bar chart, and candlestick chart. Then we talk about the concept of support and resistance in depth, and show you the Sensex chart with the support and resistance levels, how you go about finding them. And then we talk about trend analysis and how you go about identifying the different type of trends: uptrend, downtrend, sideways trend. We talk about different type of technical indicators. There are 3 types of technical indicators: volume, trending, and oscillating. And which indicator works with what kind of trend depends on the category of the technical indicator. And then understanding the basic indicators like the ones mentioned here. We also give you an intro to Japanese candlesticks, and then finally throw it up open to question and answers and TA for script suggested by you. We also have a course on intermediate technical analysis, which is a little advanced and uses basics of technical analysis as a basis. We talk about Fibonacci retracements in that, pivot point based support resistance levels, more indicators, which are some of them are considered to be more accurate, so to speak. And we talk about a concept called divergences, classical patterns, and multiple time frame analysis. And finally, short-term buying and selling strategies, setting stop losses, and money management. This second intermediate technical analysis training is often conducted in a live market session, so it is suitable for short-term intraday traders also. I hope this video convinced you that technical analysis is not as difficult as you think, and hope it motivates you to learn it so that you can trade more effectively and improve your success rate and get profitable in the stock market. The basics of technical analysis training is conducted using a webinar format, which is a web-based training conducted over broadband. It is extremely interactive, and you get to ask questions through a voice chat or text chat. The text chat is provided by the software we provide for providing the training. You can see the upcoming training by going to the education section and then clicking on live webinars. You'll see all the future webinars listed, including the description. If you want to go ahead and register for a training, simply click on register now and go ahead and register for it. Thank you for watching this video.